Greetings, everybody. Welcome to Liberty Call. Today is Tuesday, February 21st, 2023. Hope everybody's having a fantastic day out there. Didn't have a show yesterday because it was a bank holiday and the markets were closed. So I figured there was no point in really talking about stuff because we could talk about it today. And anyways, if it's your first time watching, please give me some thumbs up, like, share, subscribes, follows, all that good stuff. I greatly appreciate it. Not the best day in the market. It looks like things took a turn south today, and maybe the reports that came out last week gave people less hope for where things are heading today. So we're going to go through the markets, the weekly economic update that was prepared for yesterday, but again, it was a bank holiday. The market recap. Let's see what else we got here. We got an article about Bernie Sanders and Elizabeth Warren wanting to raise taxes. And then last is a article from our friends at First Trust about the monetary system. So, all righty, well, let's go ahead and jump in and take a look at the numbers for today. Dow Jones was down 2.06%, closed at 33,129. It was down almost 700 points. S&P 500 was down 1.97%, closed at 39.98. NASDAQ down 2.5%, closed at 11,492. The VIX was up 7.44% today. It's currently at 2281. Canada was down 1.28, Brazil down 0.7, Mexico down 1.28. Our friends across the Atlantic, Germany down 0.52, the UK down 0.46, France down 0.37, Eurostoxx down 0.49, Netherlands down 0.65, Spain down 0.31, Italy down 0.68, Switzerland up 0.14, one of the few bright spots. Portugal down 0.1%. In Russia, let's see, the MOEX was up 1.32. The RTSI was up 0.81. And the overnights in Asia, Japan was down 0.21. Australia down 0.21 also. New Zealand down 0.76. The Shanghai was up 0.49. The SESC component up 0.12. China A50 up 0.02, so basically flat. DJ Shanghai up 0.51. Hang Seng was down 1.71, and the Taiwan weighted came in up 0.08%. All right, so that's all the markets for today's trading day. Like I said, didn't look real good, but these things do happen. All right, let's go ahead and bring up the weekly economic update that came out yesterday. The week on Wall Street, growing concerns about further interest rate hikes prompted by fresh economic data reversed early week gains and left stocks mixed for the week. The Dow Jones Industrial Average slipped 0.13, while the S&P 500 fell 0.28. NASDAQ was down 0.59, and internationals gained 0.52 for the week. Rate concerns weigh on stocks. Stocks opened last week higher on investor hopes that continued cooling and inflation might support a more dovish Fed. A higher than expected rise in consumer price in the Consumer Price Index, or CPI, and strong retail sales in January initially did little to dent that enthusiasm as stocks posted solid gains through Wednesday's close. But that optimism faded on Thursday as a surprising rise in producer prices and another decline in initial jobless claims triggered worries that the Fed would stay the course for longer. Again, I've been saying that for quite a while. Comments from two Fed officials supported a more aggressive rate hike stance, added to the unease, erasing much of the week's gains. Stocks ended mixed on Friday, capping a choppy week. Inflation moderation pauses. Consumer prices climbed 0.5% in January, fueled by rising shelter costs and energy prices. The increase in the CPI was higher than the 1% rise in December and slightly above the consensus estimate of 0.4. Year-over-year inflation number at 6.4% came in lower than December's 12-month rise of 6.5%, making it the seventh consecutive month of declining year-over-year inflation. January's product price report showed a surprise 0.7% increase, higher than the 0.4% rise expected by economists, and the biggest jump since June. Year-over-year producer prices rose 6%, a slight improvement from December's number. All right. Economic data coming out this week. On today, we have the Purchasing Managers Index PMI flash and existing home sales. Tomorrow, we have the FOMC minutes from last month's FOMC meeting. Thursday, we have jobless claims and GDP. Friday, new home sales and consumer sentiment. Companies reporting earnings this week are Walmart, Home Depot. On Tuesday, Walmart, Home Depot, and Palo Alto Networks. Wednesday, we have eBay, TJ Maxx, NVIDIA Corporation and Diamondback Energy. Thursday, we have Block Inc. and Pioneer Natural Resources. And Friday, we have EOG Resources. All right, so that's everything for the weekly update. Let's go ahead and bring up our market recap. SP 500 slumps as rout and retailers and tech bites. Let me bring up my notes. On Tuesday, the SP 500 slid as Treasury yields surged in. A slump in retailers put pressure on growth sectors of the market, including tech. This followed growing fears that the Federal Reserve will need to implement further rate hikes to cool inflation. The 10-year Treasury yield rose nearly 4%, the highest, to nearly 4%, the highest level since November of 21, as investors' expectations for a rate cut this year dwindled. The odds of a June hike also jumped 16% compared to just 5% last week, indicating that rates may increase beyond the Fed's previous projection. Again, who's been saying that? Me. Investors will look to the Federal Reserve minutes due to be released on Wednesday for insight into the central bank's thinking and on monetary policy measures. The surge in rates continue to impact growth sectors, with tech companies such as Apple, Alphabet, and Microsoft all down approximately 2%. Sentiment on chip stocks was also dented by fresh signs of softer demand. A report revealed that Intel delayed an order for semiconductors from Taiwan Semiconductor Manufacturing until next year, impacting consumer discretionary stocks. Home Depot fell over 6% following quarterly results that missed on the bottom line and guidance for 2023 earnings per share that were below Wall Street expectations. The company stated that it expected a moderation in home improvement demand due to rising interest rates, heightened inflation, and moderating equity and housing markets. Walmart cut intraday losses to trade flat despite reporting guidance that fell short of expectations. DocuSign slumped 10% after UBS downgraded the company from to sell from neutral amid growth concerns. However, General Mills bucked the trend of disappointing outlooks from retailers, upgrading its full-year forecast on revenue and earnings, which sent its shares more than 5% higher. In summary, the surge in Treasury yields, rate hike concerns, and slump in retailers led to the SP 500's decline, with growth sectors like tech being particularly affected. Investors will eagerly awaiting the Federal Reserve's minutes to gain insight into the central bank's plan for monetary policy measures. All right. So that's everything for today. Next up on the docket is a article here. Opinion: Bernie Sanders and Elizabeth Warren's bold tax hike to shore up Social Security. So let's bring up my summary here. Democratic Senators Elizabeth Warren and Bernie Sanders have proposed a bill that seeks to increase the top rate of income tax by a third and the top rate of capital gains taxes by more than half. As part of efforts to balance the books on Social Security and expand its benefits, the bill proposes a 12.4% payroll tax on ordinary income above $250,000, which would raise the effective top rate to 49.2%. For those earning more than $250,000, the bill would add a 12.4% payroll tax on investment income, including all capital gains, long and short. The proposal would increase the top rate of capital gains from 23.8 to 36.2% on your investments. Wow. I personally, I don't see this going anywhere. It's a pipe dream. I put more of a chance that the federal government will collapse under its weight of debt, but I just don't see this getting through the Congress. The bill's personalized approach aims to increase awareness about how much some of America's top executives earned last year and how much additional tax they would pay. Although the bill is being referred to as taxing, quote, millionaires and billionaires, end quote, it only applies to individuals earning more than $250,000. I don't know a lot of millionaires and billionaires. Well, I mean, yes, you can be a millionaire and billionaire on a $250,000 income, but it takes a while to get there because you got to live and pay the taxes. So, I mean, at a $250,000 income, you're probably giving up somewhere between 30 and 40% to all parties involved. So you're losing a decent chunk of money. And the bill is designed to produce bracket creep as more workers are included each year. The proposal does not include wealth or asset taxes to the very rich. The bill faces an uphill battle with little chance of becoming law. However, it is believed that Warren and Sanders are using the proposal to move the Overton window on taxes, a public relations concept that describes a range of political ideas deemed acceptable by the mainstream discourse. The timing of the bill coincides with the approaching battle over the future of Social Security and Medicare, whose trust funds are due to run out of money within the next decade. Probably less than that, quite honestly. The issue also intersects with the current debate over raising the debt ceiling, in which Social Security and Medicare spending may be on the block. Republicans are reportedly considering cutting future projected payments as part of the solution, while Warren and Sanders are pushing for a liberal alternative. Personally, I'd just like to have my money back from the Social Security system, and I'll invest it myself. I kind of know what I'm doing. So, all right. Last up comes from our friends at First Trust, Brian Westbury, their chief economist. It's titled "Monetary Mayhem: Cloud's Crystal Ball." All right, let me bring up my notes for this. Financial news these days is filled with speculation about what the Federal Reserve will do with short-term interest rates, what they will do, when they will do it, and for how long. However, investors need to shift their focus to the money supply. Prior to the 2008-9 financial crisis, the Fed implemented monetary policy by adding or draining reserves to the banking system, depending on whether they wanted to loosen or tighten monetary policy. The interest rate banks charged each other to acquire reserves was highly sensitive to Fed decisions. However, after the crisis, the Fed switched to a model based on abundant reserves, flooding the banking system with more reserves than banks would ever need, making those reserves valuable by paying banks interest to hold them. As a result, short-term rates are ultimately decreed by government edict, and the market process of banks trading reserves no longer exists. Investors should focus on the M2 measure of the money supply, which soared 40.4% from February of 20 to February of 22, but declined 2.3% in the last 10 months of 2022. The Fed has never fought an inflation problem under an abundant reserve regime, and the M2 measure of money has never grown so fast for so long or declined so rapidly since the Great Depression. While the futures market is currently pricing in 3 more rate hikes of 25 basis points each and 1 rate cut of 25 basis points very late this year, this is just a guess about how the Fed edicts might change. Investors should look at the January M2 data to see if the drop in M2 continued into 2023, which could influence how shifts in interest rate policy will impact M2 growth in the months ahead. One significant question is whether lifting rates has slowed M2 growth, or if it is just that rates are higher. This is crucial because monetary policy hits the economy with long and variable lags, and we have already seen some weakness in production reports. There is a storm headed our way, and investors must be prepared. The unprecedented period for policy with abundant reserves means that educated guesses, not definitive answers, are the best anyone can do right now. All right. Well, that is everything I had for today. So, unfortunately, it's kind of a bleak picture out there right now, but we'll get through it and hopefully navigate the major pitfalls that we have upcoming in the next couple of months and the rest of this year. So hope everyone has a fantastical evening. I will be back hopefully tomorrow. And if anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. If you want to book a meeting, drop me a phone call, or send me an email, please do. Hope everyone has a great night, and I'll talk to you later. Adios.